So in our migration workflow, we are now up to the investigation section. And before we jump into the system to look at why do we have those differences, I'd like to review with you some of the kind of ways in which the two calculators operate differently. So the slide that you see here, these are some generalizations. And the reason I say generalization is that the behavior doesn't necessarily appear in every single org because it depends on how your rules are configured, whether or not you might experience some of these differences. And it's very important that you kind of understand what these differences are because it's going to help when you're investigating, identify why, and to be able to understand, is this an actual issue or is the new calculator actually correct and I'm okay with this going forward? So in detail, when you had an accrual period span a reset date, so an example of this would be, let's pretend you have a bi-weekly accrual pattern and there is a pay period that runs from, I'm just going to throw out some dates there, December 20th to January 3rd, but your plan resets on January 1st. In that scenario, in the old calculator, it could cause some incorrect carryover values because the system would, in some instances, again, depending on your configuration, either give you more carryover than you, more accrual than you should, or it would give you not enough. More often than not, the old calculator would give you more than you should, which then means that you're carrying over more than you should into the next year. The new calculator, however, if you do have the same scenario, will actually prorate the accrual into a portion before January 1st and a portion after January 1st. So it will display differently, but also cause your balances to be slightly different. In our view, this is actually the more correct way of doing that. Another issue, and you'll notice on here, biweekly rules come up quite frequently because that is the area of the system most affected by time off. If you have yearly or monthly rules, chances are very high that you will not have a lot of discrepancies, but it is not impossible. If, again, biweekly rules, there was the old calculator would actually incorrectly change the value of your accrual when you change seniority dates. And if you had your plan that was front loaded, for example, it would give you the new rate earlier than you should have. Or if it wasn't front loaded, a lot of times you'd see it would go into effect the period after you actually attain that new seniority. So again, it had an effect on your balances. The new calculator solves this issue and makes sure that if you attain the number of months of service necessary to change a seniority, in that period, you will be given the new rate. So it's corrected that issue. There's I've seen this, however, not often as of late, that the old calculator would have some interesting behavior if you had an absence that spanned a reset date. So if you took off, let's again use January 1st as our reset date. If you took off from December 28th to January 3rd, it would apply those calculations in a kind of strange order, which then created issues with your balance. The new calculator fixes that. Also, we will see with biweekly rules, because again, it wasn't as intuitive of a calculator. If there are 52 weeks in a year, 52 divided by 2 for biweekly is 26 accruals. So a standard is 26 accruals. I'm not saying that's every single year because of course it always depends on your base date. But with the old calculator, it would not accurately apply the biweekly periods. And so it could actually result in some people getting an extra accrual when they shouldn't have in a plan year. The new calculator fixes that issue. And then of course, old calculator, new calculator, we finally have some applicability for FTE values. So when you are looking at the data, once we get into the system, the things that I want you to look for and start to think, put on your investigative hat, and say, why might my two balances be different? Biweekly rules, of course, that's one of the biggest things we're going to look at. And the rules themselves, are they front loaded? Is there a strange thing going on with base date? Was there a seniority change? Do we have any absences that are missing from this person's record? Is there an FTE change at play? Is there an issue of missing data in an absence accrual record or an absence adjustment? And then that one that I mentioned before, deduct order. Was deduct order not correctly defined, so the system is calculating incorrectly? So these are just some common causes of those discrepancies, and it'll be useful for you to have this list at hand when you're actually investigating on your own. So, investigation, what are the steps that you and I are about to take together? The first is we are going to look at what is the actual value of the discrepancy. How much are they off? We are going to then open up the absence calculator and the accrual log in separate screens. We are going to look backwards and try to identify at what point in time did they match, because that's going to enable us to figure out at what point does a discrepancy occur. And with that, we're going to look at what are the differences in there and try to come up with an explanation, not only an explanation of why are two values different, but how do we feel about that difference? Are we okay with this? Are we acknowledging that the new calculator is correct? Or is there an issue that means we either need to change how that rule calculates going forward, or we need to apply some sort of adjustment in order to make that employee's information correct? All right, let's go back into our system and do the work. All right, so let's just go in order here. So here we know from looking at our investigation spreadsheet, the first big discrepancy we have is Caden Whitaker. He's got a time in lieu rule that there is a 13-point difference between the two. So that's definitely one that I'm not okay with just turning on and it's okay. So I need to figure out why. Now, what's interesting is that the current balance is 13, but if I look at the year-end balance, the year-end balance is only difference is only 3.5. So I know that like something strange is going on here. So I'm just going to go right into the system and compare the two. By the way, you can get rid of your reports now because you're not going to need that for a little bit. And I'm going to find Caden Whitaker. Navigate to his employment record. And here on my absences related list, I'm going to want both the absence calculator and the accrual log to be opened up. So what I'm going to do actually is duplicate this tab. And on the first tab, I'm going to pull up the absence calculator. In the second tab, I'm going to pull up the accrual log. Little trick here, in order to split your screens very easily, you can pop one of these windows out and drag it all the way over to the side of your screen. And then the system's going to prompt you to pick the one for the other side. So now I can see Caden side by side. On the right, we have the old calculator. Excuse me, the left, we have the old calculator. Over on the right, we have the new calculator. So the first thing I want to do is find that time off in lieu rule so I can see what the issue is. So with the new calculator, which is called the accrual log, the information is paginated. So whereas on the old one, it's just one big long string, it's not separated into pages. Mine kind of has to go back. So I see that in 2020, there's no data, but let me go on and go back to 2018 because I see there's some activity in 2018 over here. Make this slightly bigger. So here in the old log, I see that he received no accrual and then he subtracted 12, is that right? 11.5 in time in lieu. And then he accrued one here and accrued one here. So I'm like, okay, that's interesting here because in 2018 on this log, he accrued 5 here and accrued 10 there. And by the way, I just noticed something that I want to make sure I have that you guys do as well. When you're doing this investigation, time off should be off. So apologies for that, but you should be doing this entire investigation without time off on. So I'm going to save that, and I'm just going to come back and refresh this here, just in case. Okay, so I already see that there's some issues with the accrual. If I take it a step further and look at 2019, because I see there is a subtraction here, but I don't see any accruals. If I look at 2020, we simply just have our balance over here. But again, I'm not accruing here. So at this stage, I'm like, okay, I have no idea what's going on. I don't really have maybe an absence adjustment that might be, incorrect data. I could open up this absence accrual and see what's going on, but why don't I just go ahead and open the rule? So in most instances, you're going to have your absence calculator on one screen, your accrual log in another, and then I would actually open up the pattern that you're looking at in another tab. So if I find that time in lieu rule, and I look at it, this time in lieu rule is a rate per timesheet. Rate per timesheet only works in the time off calculator. So in this instance, I actually have my entire explanation there. When you have a timesheet-based plan, it will not work in the old calculator. And so that's why we're only seeing the events where he subtracts. We are seeing some in accruals here. That, I will be honest, is from some testing I was doing yesterday. So probably not a great one for me to show you with some timesheets here, but that's kind of our reason here. So it's about looking at the information and saying, okay, what is the explanation for why it's different? In this instance, a timesheet-based accrual plan only works for using time off. So I've explained those discrepancies, and I know that the new calculator is actually correct. I don't need to make any adjustments to Caden because it's working correctly in the new calculator. So that's not probably the best example. So let's look at one that's going to be more realistic for your org. We've got 3 employees in a row here that have, they're on this, I'm assuming, the same vacation or PTO rule. They all have the same difference in balance and year-end difference. So let's take a look at Marge Ballard and see what's going on there. I'm going to get my split screens up, and I'm going to look for Marge Ballard. Go ahead and do that twice. And from here, I'm just going to go right to her employment record. And we're going to do the same thing of first pulling up the absence calculator in one screen, accrual log on the other screen. I'm going to collapse this, give us a little more real estate here. Okay, so PTO is the issue here. And as we can see by looking at these two, we've got our discrepancy here, 185.91 versus 186.83. And we know from our calculator here that that is a 0.92 difference in balance. So again, following our steps, at what point do the values match up and where can we identify something that's different? So in this, when I'm going through investigations, I typically first look at a reset date or a zero balance, because that's going to be, an easy time to figure out, okay, these balances should match at that stage. And sure enough, on July 27th, here at the bottom on both of these, where he was actually given an initial balance, I'm guessing there was an absence accrual somewhere, of 151.75. So everything looks okay. If I'm comparing, this column over here versus this column over here, everything is lining up. So I'm thinking, what is going on? Everything is the same until November 3rd. And on November 3rd, we see the old calculator was giving Marge 3.69, but the new calculator gave her 4.62. So that tells me something changed with her time off entitlement at that date. So to confirm, I'm going to go to the USA absence rule. I'm going to look at the PTO rule, look at my seniorities, and sure enough, when someone goes to the next level of seniority, they move from 3.6923 to 4.6153. But the two rules applied the seniority at a different time. This is exactly what I was referencing when I talked about seniority change and the date associated with it. So if I do want to take a look at Marge's continuous service date and start date are set to 11/3, which really makes sense for why we're seeing this, because in the old calculator, the old calculator did not grant the new seniority until the individual had completed the period in which they attained that new seniority. So she didn't actually get her new seniority until November 10th. In the new calculator, it grants that new seniority in the period in which they obtain that seniority, which is why we see the greater value here. If we use our little calculator here, now mind you, we do have some rounding that we might want to take a look at. So let's pull our full amount over here. If I take 4.6153 minus 3.6923, I have a difference in balance of 0.923, which matches my difference of 0.923. Now, these balances that you get in your report are going to be the rounded values. Just take note of that. And so now I know why their balances are different, and I feel much better about that change. So that to me explains the current information, but why is her year-end balance off by I think it was 2.77? Because that doesn't seem right either. But in this new one, I'm just going to hide all this information here. And let's unhide that and pull in our year-end balance. We have a year-end balance difference of 204.37, was higher on the old one, and they're actually losing out, it appears, on the new calculator. So I need, even though I'm comfortable with this and I don't feel like a change needs to be made, this kind of worries me because I don't understand why it's gone up to that. So let's take a look. So with this last item, there's another trick that you can only use in time off. And you can only use this trick when you are in time off and in classic. So if I go to accrual log, which is using time off calculations, and I go to my URL, at the end of the URL, I can type and, or ampersand, year end equals true. And when I do that, it's actually going to change the information displayed on that accrual log to go through the end of the year. So I can see what are her accruals going to look like through the end of the year. Now, no similar feature exists on the old absence. So you kind of have to use a little bit of inference on what's happening between the two. So here I can see that at the end of the year on December 31st, for some reason, Marge gets a tiny amount of an accrual. Now, this is speaking to, let's go back here. accrual patterns that are spanning a reset date. In the old calculator, in this instance, the old calculator is actually granting the entire amount of the accrual as opposed to prorating it from one to another. Because technically at 12/31, March has not completed an entire period. So she's not entitled to that entire amount of calculation the way this rule is set up, which is why the new calculator correctly prorates that amount. If we want to look at this a little more visually, let's see if I've got this handy. Here's an example using Jenna Austin, who's actually also on our list of people to look at. We have the change in seniority that causes an initial difference, but then when we're looking at year-end totals, the old calculator gives the entire amount of that accrual on that partial piece of the year from 12/30 to 12/31, rather than a prorated amount that more accurately reflects the time that is available in that year. So again, the reason for these discrepancies or changes or the disparate information is that the two rules are, of course, are behaving in different ways. Now, at this juncture, you have, again, a decision to make. One is, am I okay with this? And, I believe that the new calculator actually is correct, and this should be their balance. If that's the case, then you know what you need to do going forward. However, if you're not okay with this, but you're like, okay, she still thinks she should have, where's Marge here, 204.37 at the end of the year. The new calculator would have given her 201.6. I would rather her have 204, but I agree that 201.6 is actually probably correct. That is what we are aiming for in looking at what our next steps are. So I know that's a pretty complicated description there, so bear with me and we will go back to that. So we could do these exact same steps with all of these and find out, again, what are the discrepancies. I will tell you 9 times out of 10, it's because of seniority change or a prorated accrual period. That is I would even say 9.9 times out of 10, that is the reason for the changes. As mentioned before, we should always do our sorting both ways. Kate and Whitaker, we've already looked at, so let's look smallest to largest now. Are there any others that I might want to look at? So again, we're looking at what are the values? Are we okay with the values, and can we explain why the values are different? If I look at this here, I've got all these people with 5.17 as the delta. I can guarantee you, just because I've done a ton of these, that they all have the same issue. This is a bi-weekly pay rule, and when that bi-weekly pay rule has a period that spans a reset date, the system prorates. So if this were my org and I'm looking through this, if I can explain all of these things, I know that I can then move on to the next step. So the next step, migration edits. And here's where we're going to start talking about scenarios. Because what you do next is going to depend on the investigation that you just completed. In scenario number 1, there is little to no difference between the two calculators across the employee base. So the balance they have right now is exact or off by 0.01 or whatever margin you are comfortable with. And their year-end balances, everything looks fine. If that's the case, there's nothing you need to do in terms of edits. You can just turn it on and proceed to the next steps in this presentation. Scenario 2, you might have just a few employees where you're like, look, I think the new calculator is working correctly, but I want to give them their balances from the old calculator. That is going to be a very common scenario for most people. The third scenario, I would say, is probably going to impact larger organizations, organizations that have biweekly accrual rules, or very, very complicated accrual rules with perhaps multiple carryover periods. Most of you are going to need to use scenario 3. Scenario 3 and scenario 2 are very similar. We've got the difference is a few employees versus a lot of employees have minor differences. If we are looking at scenario 2, let me show you what you will need to do. So let's say you've done your investigation and you've decided that Marge Ballard, we actually want her to have the balance. Let's find Miss Ballard again. So the balance that Marge had on the old calculator is 185.91, or, actually I'll get to that. So, we believe that the old calculator is correct, and we want to make sure that she uses that one going forward. What we would do is go to Marge's profile. Again, make sure you are not in time off. And then whatever date you have decided you are moving forward with time off, like whatever your, this is my date I'm selecting is, you are going to create an absence accrual, just manually. These are just one-offs that you're doing this for. And for effective date, you're going to want this to be the day before that migration date. So if we look back at this again, let's pretend for the sake of argument that you wanted this to go live November 3rd, or sorry, November 1st. Let's use November 1st. That's a little bit of an easier one. So on November 1st, according to this actual log here, her balance was 177.6 on that date. So I'm going to create a new absence accrual. I'm going to make it effective the day before that. And I'm going to look up the rule that we're on. I know this is I think this was US vacation PTO. You know what? I'm not at all confident of that. So let me actually make sure that I have it up here. Let's pull up her absence. PTO. Okay, much better. I've got my rule name. So here we are, our absence rule. Going to populate, and I'm going to enter in here the value that I want her to have on that date, 177.6. I would save it, and then that is going to enable me to give her that balance so that I can make the changes needed to my rule or simply turn on time off, and her balance will start on time off using that new balance. So I don't think very many clients are going to have that scenario, but if you do, that's great, because then you're just doing a couple of one-off changes, creating an absence accrual, and then following the rest of this presentation to turn on time off. But I do want to spend some time on scenarios 3. So in a way, I've got 2 different scenarios within this scenario. The first is, are you doing this change to time off on your reset date? Reset date is the easiest time to do this because that is the time in which your balances are most likely to be identical, because it is, well, a reset. You haven't accrued anything yet. If you are using that method, I have specific instructions for that. The other method is maybe you can't do it on your reset date. Maybe you are worried that this is, or maybe you do not have time to actually do this investigation before, let's say, January 1st. And so you want to do this on April 1st. Then that is kind of method 2 in what I've referred to, as mid-year method. So reset date method and mid-year method. You're going to use this if you have many employees that have minor differences. And you're going to go through a very specific task. The first thing you're going to do is identify the absence accrual rules that hold these employees. So you will notice when you're doing your investigation here, like all these people are on the same rule. And so we know that there is an issue with how these rules vary within the new system. Now, I'm trying to look, excuse me while I scroll really quickly. Let's get rid of that. Just looking for there we go. I do have a whole series of rules though, where there is no change in behavior. So I know that I actually don't need to do anything with these rules. I can honestly just ignore them. What you want to focus on are the rules where there are differences. So we know that this US vacation PTO rule has an issue. What you're going to do is go into the rule itself. So here I've got my USA absence, vacation PTO, and I have a button called Create Accruals. I'm going to click that button, and when I do this, based on the date that I tell it to use, the system is going to generate an accrual record, which you can think of it as a line in the sand. On this date, this is the balance, and it will be the balance going forward if I make any sort of changes to the rule. So it enables you to change something while locking in an existing balance. Looking at our presentation, if I'm doing this on a reset date, you're going to put this as the day before the reset date. So if you have a January reset date, you would want to make this effective date the day before it. Now, it's a good time to note here. Let's say I'm doing this now because I want to transition as of January 1st. Unfortunately, this part of the system will not allow you to do things in the future because you could have things change between now and then. So if I know that I want to do this at the end of this year and I try to put in 12/31/2020 and submit it, I will get a note to please provide an effective date that's in today or the past. So just note that you can't do this in the future. You're going to have to wait until January 1st to actually take action on it. But maybe I look at my investigation data and say, actually, everyone was fine as of the 1st of this current year. So I'm going to stamp in time, draw a line in the sand on 12/31/2019. And that's going to be my migration date. You would do this, you put the date in there, and you would click submit without entering any information in there whatsoever. And I'm going to show you what this does. We're going to use, I'm just going to find a test employee here. Let's do good old Steve Pendleton. I'm going to put him on a test pattern just that I've created that makes it easy for me to illustrate this stuff. It's just a standard hourly pattern. And then I'll show you both behaviors. So we're going to do the same thing. I'm going to go into my pattern, create accruals. And if I wanted this to be effective January 1st and I'm doing a reset date method, I'm going to put that down there. Click submit. You're going to get this pop-up message that accruals are being generated. We'll send you an email when it's finished. You will get an email when it is done. It may take some time depending on the number of individuals that you are doing this for. But if I go ahead and go back to Steve's absence calculator, I see that it's actually already created. And sure enough, I see his balance as of 12/31/17. And it takes from there, it basically starts him over on that date. So that's what it does, is it creates that record. Now I'm just going to delete this out. And if you were doing a mid-year change, as opposed to making this migration happen at a reset date, the difference in task is that your effective date, rather being the date before the reset date, is going to be the last day of the accrual period prior to the date that you are turning this on. So if we are looking at Steve again, actually what we're going to do is, I believe this is my bi-weekly. There we go. Let's use USA absence because now we've got a bi-weekly plan to play with. Oh, must have entered that incorrectly. USA absence. There we go. Okay. So if I look at his absence calculator, I'm going to go back and I'm going to look at those periods. And so if we're using this same sort of idea about, a mid-year change, let's say I wanted to make this effective, I'm pretty happy with the balances now, so we're going to make it effective November 3rd because that's the start of a accrual period. What I would then do, and I see on this date, Steve's balance was 93.54. I'm going to go into my pattern, create accruals. And if November 3rd is the first day of that period, that means the last day of the prior period was November 2nd. I'm going to submit. And it's very important that you're doing this using the Create Accruals button. The difference between the Create Accruals button and the new Generate Accruals button is that, number one, the Create Accruals button is looking at the balance using the absence calculator, the old functionality, whereas the Generate Accruals button looks at what is the balance using the new time off calculator. So if I want my employees to get the balance that they are currently seeing, I want to use Create Accruals. So now if I go back into Steve and refresh, hopefully it has now finished 93.54, and we start the new scheme on November 3rd. So all I've done is tell the system, keep this balance on that date, and then going forward, we will use the new one once I turn it on. Scenario 4, which is highly unlikely, if you are seeing major differences in balances across the board, and there doesn't seem, to be a very easily explainable reason, then at that stage, you may need to review the actual rule setup. So what could be occurring is that, as I mentioned at the start of this conversation, the old calculator allowed you to kind of accept a bug as configuration because the system worked a certain way and had a certain effect on balances. It enabled, you may like the end result, but it actually wasn't calculating correctly. So what you may have to do in those instances is actually play with the rules themselves. Look at your settings. Do they need to be changed? Is there something you need to change in the seniorities or the front loading or the pro rata setup? And if you can get the rules to work the way you want them to, then you would actually, now that you know what you need to do, you would come back to scenario 3, generate accruals to stamp those balances for all your employees. And then rather than just do the steps that we're about to show for turning on the features, you would also change the rules at the same time to be the new configuration. That's a highly unlikely scenario, but one that, definitely if you do run into, checking with your customer success manager on next steps would be advisable. Okay, so assuming we have done all of those migration edits that we need to do, the next step in our migration workflow is to disable those features that are for absence. So there's a couple things that we need to do. We're going to need to disable that absence balances batch if we were running it. We're going to need to remove that absence balances related list because it's no longer going to give us the better information. We're going to remove the absence calculator button, and we are going to remove the absences process entirely. So back in our system here, give me one moment. All right. So to do this, we are going to repeat some of the steps we've seen previously, and we're going to go to installed packages. You're going to go to your HCM configure page, and you are going to find that hold absence balances entry and make it not active. And you're going to want to save it because we're no longer going to use that going forward. I would keep this installed packages handy because we are going to use it again. The next step would be to go into an employment record, and we're going to remove the related list for absence balances because it's no longer going to be relevant because we just deactivated that batch. So again, we're going to click Edit Layout. We're going to click Related List, find absence balances, and remove it. Simple as that. And save it, and we are good to go. Now, if I was smart and read ahead on my on my presentation, I omitted the next one, which is also on the employment record. Within that related list for absences that we've been working in this whole time, I'm going to want to remove that absence calculator button because we no longer need it. So I'm going to click the wrench, go to my buttons at the bottom, and I'm going to remove absence calculator, OK, and save. Again, if this is a time where we're going to be turning on this functionality, the other place I'm going to need to go is my WX services. I'm going to find the service in which I have absence. So here in this org, it's called time. And you probably would see your process for whatever you use to request time off would say absence. You would actually remove that and then replace it in next step with one called time off. So WX processes and services is where you'd go for that last item. The last step is to enable your time off features. So for this, we are going to be creating that process for time off that I just mentioned. We are going to add some fields to the absence accrual rule. We are going to go back into installed packages and actually enable something different. And we are going to make sure that going forward, we can use our system in all the other areas that we've been using it. So for that, as mentioned before, WX processes, you're going to create a new WX process. And for this one, rather than selecting absence for the WX process type, you just need to be sure to use time off. Since I already have one, I'm going to cancel that. Next item on our list was to go into the absence accrual rule and add a new field. So as part of the features that have been rolled out as part of time off, with the new accrual balances batch, you can not only query the system for what is my current balance and my start of the year balance, but what were the balances at the end of previous years. So you can get a little bit of historic information about how your employees were using their time off. From this, I'm on a rule. I'm going to click Edit Layout. And there is a new field called accrual record years, which I've already added to my field set, unfortunately, here, but you would get this field from in here and drag it down wherever you would like and save that. The next two items are back in installed packages. The first one is going to be actually in the time package configure, which is an area we have not yet visited today. In this area, we can enable the accrual balances batch. Again, this batch replaces the absence balances batch and is fantastic. So from this, you can schedule that batch to run at a specific time. You can also specify the batch size. We do recommend using one. The batch will run faster if you have a larger number, but unless you've got tens of thousands of employees, you're likely to be okay with one. But if you do start to notice some performance degradation, you can play with the batch size there, and you will save that. Also in installed packages, we're going to go back into the HCM configure. And we are going to enable time off and time off for pay flow so that we can also use these new balances that we are generating in pay flow. Once you have that, you will save. And I'll ask that you refer to some of the other areas of the community where we've got instructions on setting up some of the other features such as partial day absences, work schedules, etc., which you can now take advantage of now that you are using time off. So to wrap up, some other considerations that I would like for you to think about is employee communications. So what we've been through today is the process of what do I need to do and how do I do it and how do I make this switch. But remember, as I'm sure you are all acutely aware of, we are talking about people's absence balances. This is, crucial information that, when an employee sees a difference, they're going to question it. I'd say most likely they're going to question it. So I do recommend that you start to think about a communications plan. I have written up here a very basic statement that you can use, such as, our absence system will be undergoing some changes effective X date. That would be the date that you're turning on time off. On that date, you might see a change in the display of your absence totals. It's more accurate. Your annual entitlements have not changed as part of this project, and alert your manager or HR partner or whomever you have designated to deal with these questions if you have any issues. So we do recommend that you send something out because employees are going to notice if their balances are different. One thing to consider that I have seen a couple of customers adopt is that if the new calculator balances seem to favor the employee, meaning their balances are always higher, which could happen depending on the configuration of your rules, some have considered just turning it on even if there are differences because the change is in favor of the employee. In pretty much any legal advice that you get out there, they'll say if a change is more in the favor of the employee, it's okay to change it. But of course, consult with legal and compliance counsel if you have questions on that, but just a good point to keep in mind. Once you've enabled time off, there are, as mentioned, new fields that are available that you're going to want to start playing with, especially if you're enabling things like partial day absences or the accrual balances batch. And you're going to want to make sure that you can take advantage of these new fields within Payflow. So as we looked at those reports previously, actually, I'll just pull up here. We have all these new fields that were not available previously that we can also use in Payflow, such as at what value did they start the year for accrual and carryover. You previously didn't have that information. So take advantage of that and make sure that you're using Payflow reporting to its full potential. If you have any existing WX reports that are utilizing that absence balances batch, you're going to want to update them with a new accrual balances batch. Or perhaps now's the time, now that you've got more data, to create new WX reports that are going to help support this. And then, as mentioned previously, obviously you're going to have a lot more that you can take advantage of now that you're on time off, but maybe consider doing your time off migration in conjunction with the launch of this new functionality. And that's just more of a best practice in terms of it's better to make one change event with multiple changes than to have one change once a month or 3 months in a row. It's just easier for employees from a change management perspective to say, okay, now I have this and this and this, and yeah, my balance is a little different. It also might help from an explanation standpoint why they are seeing some different information. So it's a good thing to keep in mind. And with that, in 1 hour and 44 minutes, we have time off migration. So I have been trying to take a look at the Q&A that's been coming in, but I'd like to start taking a look at that. I do have a colleague on the line who's been managing some of the responses back to you guys. Heather Brickowski, are there any common questions that we should maybe start with?
Yes, hi there. So there was one regarding reporting, but I think we kind of just answered that. The question was whether we needed to rebuild absence reports following not being enabled.
Unfortunately, Heather, I could not really hear you on that. I heard something about reports though, so let me scroll through here. Do we need to rebuild absence reports following time off? Gotcha. Yes, if you are using WX reports that are based on the absence balances object, you're going to want to rebuild those using the new features. Now, you can keep them. I will say, like, you could keep them, but you will get better, more accurate information using the accrual balance, as well as some additional fields. And while I do not have 100% confirmation, my gut tells me that when they completely deprecate the absence process, they will also deprecate that absence balances object as part of it. So I do not have that confirmed, but I would say just to, heavily consider changing that. Any existing reports that you have that are just looking at absences, so total time taken, start date, end date, occurrences, those will have no effect with this change. Heather, do you want to try another one? See if I can hear you better.
Sounds good. We'll see if this works better. Can you hear me now?
Yeah.
Okay, excellent. So the next question actually was regarding a reset date of January 2021, and they were going to introduce carryover caps at the same time. Is there anything that they need to take into account or be aware of based on having a carryover cap?
That is an excellent question, and I'm so glad you asked that. Absolutely, you need to take this into account. So the way the absence system works, and I alluded to this earlier on in the presentation, if you change something in the rule that affects the balances, so if I were to come into the seniority, and if previously I've never had a carryover cap or I've never had a maximum accrual, if I go ahead and just add 5 now and save this, the system is going to assume it's been this way from the dawn of time. So any existing balances would actually have those caps applied, which means you're going to see your balances go down because you've now applied a carryover cap. So this refresh to time off is an excellent time to introduce something like this. So my advice would be, if you're doing this all effective January 2021, is on the 1st of January or after. To be perfectly honest, you could do it any day after, but it just needs to be January 1st or after. You are going to follow the same steps that we saw here. You're going to create your accruals to make sure that your employees have the balances that you want them to for the time off migration. Now, if from doing your investigation, you're actually thinking, I don't need to make any changes, everything's fine. Well, what you're going to need to do is, for the rule in which you are applying those carryover limits, you are going to want to generate accruals on that rule, because you're going to want to make sure that the employee's balance that they had on 12/31 continues into next year. So if we're looking at this, the instructions would change to say, create accruals on the rules that are affected by the time off migration or the new carryover caps. Once you have then created those absence accruals, the create accruals, you can then change your rule, and it will only go into effect as of January 1st. So great question.
Thanks, Sarah. So we have another question regarding deduct order. And does that just pertain to vacation, or is that absences too? And then the second part is, does it vary by rate per equals not accrued or something else?
That's a great question. So the question, if you couldn't hear it, is when we're looking at deduct order, does it only pertain to vacation, or does it also apply to absences as well? And does it vary? Does the behavior vary by rate per accrued or not accrued? I will admit to the poster of that question, I haven't gone as in depth to figure out if there is any tie to the rate per or not. But my gut actually tells me that there isn't, because what you will find is if you've got an absence rule, you could have an absence type rule that is still accrued, just depending on how you as a business designate this plan. So an example would be you could have a sick leave rule where employees get, let's say, 40 hours a year. They accrue 40 hours a year, and you may or may not allow carryover. So even though that rule is not a vacation type rule, you still want their deduction order to apply in the same way. And what I mean by that, I'm going to go ahead and edit the layout because this is actually a kind of a two-part with a bonus here, is that on your accrual rule, once you've migrated, you're going to want to get rid of the create accruals button because you will no longer use it going forward, and replace it with generate accruals. And there's a button for deduct order we're also going to pull in. When you are changing deduct order, my advice is that you do not just type in here what you want the deduct order would be. Instead, you utilize the button for deduct order, because even though this is an absence type rule where I'm not likely to have time in lieu, but I guess depending on your rules you could, you want to make sure that the system is going to deduct carryover before it deducts from accrual, if you allow such a thing. So my recommendation is to just do this across the board and actually have that information set for our rules. I do not, it's possible that it is tied to the rate per, but I do not know that for certain. I'm happy to follow up with the poster if I can get clarification from our product team.
Perfect, thanks, Sarah. There was another question regarding whether if they have PTO set up and they do not grant pro rata, does that make it easier to go through this process because the calculators will most likely be more either the same or similar if not using the pro rata?
So the pro rata is definitely an area that may cause some differences. If it is a yearly setup, front-loaded, full and full, or even a monthly setup, full and full, you are not very likely to have very many differences at all. But going through these steps will quickly validate that. Or even if you didn't want to go through the full ordeal of running the reports and stuff like that, you could do the same things I've been doing by opening up absence calculator and accrual log in two separate windows and just doing a quick comparison. But front-loaded, full, monthly and annual rules are likely to have very little. Where I see the most discrepancies are when you have a bi-weekly, even semi-monthly teams tends to be pretty easy, but bi-weekly or weekly, because those are things that can vary based on if it's a leap year or when the base date is. And if something has any sort of, actually don't even have it in this trial org, when you have this set to pro rata, that's definitely when we see more changes in values. But I would definitely validate before doing the switch.
Great, thank you. I see one more question. What is the best migration method if we have different HR departments with different reset dates?
Yes, the million-dollar question here. Okay, this is probably the toughest question to answer of all of them. And best case scenario for this, if you've got multiple departments, and again, utilizing this hacked list view is a great way to kind of get a handle on what you're up against. I can go ahead and edit this, and let's pull in reset day and month. So in this trial org, looks like everything, oh, I actually do have some June first, and then I have the bulk of mine are January. What The thing with the time off migration is that you cannot turn it on for just some groups. It is an all or nothing global feature. So you are going to have to prioritize the date. My advice would be based on where you have the largest population, because if you have, let's say your largest population has a January 1st reset date, and that is 75% of your team members, then I would go with January 1st as your target date for turning this on. That way, if you have issues with these other rules that do not have a January 1st reset date, you can simply utilize scenario 3, and you're still going to do the same steps, but your effective date is going to be a different effective date. And even though it is going to be slightly different, it's a lot easier to manage a one-off change on a handful of employees versus 75% of your employees. So if you do have different reset dates, I think it is an added layer of complexity. And again, my advice is find where are the predominant numbers in your org, use that as your reset date so you can transition all those people at a reset date. And then for the other departments, use the mid-year migration method. If possible, also do it as of January 1st, because that's going to enable you to do more along the lines of communications and making sure that, you know, all your employees are getting the same communication. And again, it's just easier to deal with those one-off changes.
Perfect. Well, those were all the questions that came in.
Perfect. Let me just take a look at the list here. Oh, here's a great question that just came in. This is the question is, we have created accruals in the past, but it didn't pull across time in lieu or carryover, so it was incorrect and we have to manually adjust them. That is a great insight, and there are a few gotchas that honestly I probably should have mentioned to you about the create accruals button. So when create accruals is simply looking at least for the purposes of this, it's your balance on the day, and it's setting that balance as your accrual balance. So if on today I've got 10 hours, it's going to say, okay, I've got 10 hours of time. If I had 10 hours of carryover, it's going to say I now have 10 hours of accrual. But one very, very important thing to note is that when you use the create accruals button or even the generate accruals button, the behavior is the same. The system, and I have raised this as a bug, so you know, hopefully I'll get some information on it shortly, but if you have a negative balance, the system, when you click generate accruals, it creates an accrual record, but it omits the negative. So it's just one extra layer of things that I apologize, I should have put that in the presentation notes, is if someone has, when you're going through your investigation checks, look for anyone who has a negative balance. Because if you're going to be using generate accruals, you need to make sure they don't have a negative balance on the date in question. Otherwise, you just have to manually edit it. So that could be what this individual was experiencing, is that time in lieu isn't something that's really picked up by the create accruals batch. So it's a good thing to note. And with that, I think we have everything with 2 minutes to spare. So kind of final words here is, we are, you know, here to support you as best we can. We will have this webinar available for replay as soon as possible. I do recommend walking through it, pausing, doing the steps that I just did, coming back to the presentation and continuing on. But also make sure that you're keeping an eye on the customer community, where we will be publishing any available information or resources or tools for this migration. If you have questions on any of the content today, please reach out to your customer success manager. And if necessary, they may direct you to raise a support case if it's something that's outside of the bounds of this migration. Have a wonderful day, and thank you for attending.